Renting versus buying. What is the best option? If you're currently renting and have wondered if it's better to rent or actually buy, this video is for you. I've ran the actual numbers and we'll look how things compare. Hi, I'm Murray with the Zelinski Realty Group, and being licensed as both a realtor and a mortgage associate, I can walk you through both sides of this math in one conversation. Also, if you'd like to know how your specific numbers look as a comparison, message or call me directly and I can have a run through on those numbers for you. Having your exact numbers will give you the knowledge in making an informed decision as to what is best for you. So here's what we're comparing today. On one side, buying in Spruce Grove and Stony Plain. So we're going to look at a 3-bedroom single family home between $350,000 to $425,000 and a 3-bedroom townhouse in that $300,000 to $400,000 range. On the rental side, a comparable 3-bedroom home in West Edmonton. Now, interestingly, some first-time buyers I work with default to renting in the city because it feels simpler. However, I wanted to know, does the math actually back that up? So let's start with the rent side. Currently, a 3-bedroom detached house in West Edmonton runs approximately $2,100 to $2,300 a month. A 3-bedroom townhouse or condo runs approximately $1,800 to $1,900 a month. Family-friendly areas of West Edmonton like Terwilliger, Summerside can actually run above the city average because that's exactly the kind of home a family needs and have a high demand for. That typical home has 3 bedrooms, generally a garage, finished basement, and a yard space to grow into. Renting does give you flexibility and zero maintenance responsibility, which does make things a little easier. But let's see how this stacks up against home ownership. Now, let's break it down on a single family home scenario. Let's look at a purchase price of $390,000. With 5% down, that's a down payment of $19,500. So that leaves a mortgage of $370,500. Since it's under 20% down, it is considered an insured mortgage. This means there's a default insurance premium of 4% added to the mortgage. And that's going to be an additional $14,820. That brings the total mortgage amount to $385,320. Now, the default insurance is a premium that you, the borrower, will pay that covers the lender in case you default in making your payments and the lender has to foreclose against you. However, since it isn't an insured mortgage, the lender will offer you premium mortgage rates compared to putting down 20% or more. Now, if we look at today's 5-year fixed rate for insured, that's approximately 4.09%. On a 5-year term with a 30-year amortization, that mortgage payment works out to approximately $1,860 a month. Now, one of the things to know, I currently recommend a variable rate, which is coming in around 3.6 to 3.7%, depending on the lenders. If we went on a variable rate, that would lower the monthly payment as well, too. But we'll stick with the 5-year term for now for the comparisons. As a side note, this is definitely a key conversation I have with you in deciding what fits best with your finance direction. If you want to know how this can actually impact you directly, send me a quick text with VAR for variable, and we can talk further. All right, let's get back to the numbers. We will need to add a property tax to that payment. So on a home like that, it's approximately $250. Home insurance, roughly, call it about $120 a month. So your total monthly payment's approximately $2,230. Now here's the part that most people miss. Not all of that $2,230 is spent. In year one, roughly $546 of that payment is going straight to the principal. There is money that you're keeping as equity. Only about $1,683 a month is the true cost of the interest, tax, and the insurance. That $546 a month isn't a cost. It's like a forced savings because you're paying down the mortgage. That's the difference between a mortgage payment and a rent payment. One of them is actually paying you back. Now, the townhouse scenario, the purchase price we're going to work with is about $350,000. 5% down is $17,500, leaving a mortgage of $332,500. With the default insurance premium of $13,300, you now have a total mortgage amount of $345,800. working with a 30-year AM, 5-year term, that works out to a mortgage payment roughly $1,669 a month. Now, you do have a condo fee of approximately $300 on a property like that. Property tax, probably about $200, and insurance may be running about $80. So the total monthly payment now runs $2,249 a month. Here's the interesting thing. Even though this home costs $40,000 less than the single family option, the total monthly payment actually comes out slightly higher. And that's because of the condo fee. That's a genuinely useful thing to know before you assume smaller and cheaper automatically means a lower payment. So smaller, cheaper doesn't mean it's going to be lower in the price. However, the condo fee is going to cover the exterior maintenance of your townhouse. So a little bit of a trade-off. You get some coverage on the external maintenance side of the equation, but you are still responsible for the inside maintenance like a regular home. So let's put it all together. For the single family home, renting a comparable house in West Edmonton costs approximately $2,150 a month. The true cash cost of owning in Spruce Grove or Stony Plain is approximately $1,683 a month. So owning comes out roughly at $460 a month cheaper in real cash terms, before you even count the equity being built in. For the townhouse, renting a comparable unit in West Edmonton costs approximately $1,850 a month. The true cash cost of owning is approximately $1,759 a month. So that's essentially the break even in a cash position. But with the $490 a month building equity that the renter simply does not get. In both scenarios, the number people are most concerned by is the mortgage payment, but it's actually close to or below what they already are paying in rent. The difference is where that money goes. So let's look at it a little further. One other thing to consider, and this is an important component, it is the equity gain over the 5 years of a mortgage, being a homeowner. This is the portion of your mortgage from the mortgage payment that has been paying down the mortgage balance. So as we said before, when you make a mortgage payment, a portion of that goes to interest and a portion goes to paying down the mortgage loan amount. Initially, the majority of the payment goes to interest, but over time that really does start to shift and more starts to go to the principal. If we look at the single family home purchase, 30 years at 4.09%, at the end of the 5 years, that mortgage balance, which started out at $385,320, is down to $348,800. That is a direct equity gain of $36,500. It's like a built-in type of savings in an equity form. Now, in Stony Plain, Spruce Grove, we've seen some big jumps in home values over the years. So even if you were to assume a small percentage gain per year of even 2% over that 5 years, that means your home has gone from a price of $390,000 to approximately $430,000. That's a gain in the home value of $40,000. Include the mortgage paydown equity component that we said was $36,000. That is now a total equity gain of $76,000. That's not bad over 5 years. Now, granted, if you're renting, one could say that the difference in rent compared to mortgage costs and the maintenance and everything else is a savings. And that saving component could be invested into stocks, TFSA, RSP, and yeah, that's true. But you need to ensure you are disciplined to do so every month. If that's you, awesome, but not everyone is when it comes to saving monthly. The other factor to weigh in is if you own your home, you don't need to move until you actually decide to do so. Maybe it's a job change. Maybe it's changing just a move up in the size of home that you have. Renting, even though you have a lease, you are at the mercy of the landlord as he could still decide to sell the property any time. That may force you to move even though you had no intention of moving at all. To be fair, there are real trade-offs in this kind of analysis. There are closing costs, a down payment to save for, and maintenance responsibility with home ownership. That's real, and I'm not going to pretend it isn't. If you're working on the down payment, tools like the FHSA and the RRSP Home Buyers Plan can help you get there faster, especially if you're a couple. I got a full video on that, and if you want the details, You can even message me with FHSA and I'll provide you the details further. These numbers aren't a guarantee for every property or for every buyer. Rates, prices, rents, they all shift and they move with market and the economies and such. But when people tell me renting is the safe choice, I just want them to be sure they are making an informed decision, not one based on assumptions and emotion. So if you want to run these exact numbers for your situation, such as your down payment, your target neighborhood, your timeline, that's literally what I can do for you. And that market and financial mortgage analysis is 100% free. All you simply need to do is book a call using the link below, or again, message me directly. And let's find out what your real numbers look like. And if you found this video informative, remember to subscribe to the channel and help others find this information too. Wishing you all the best on your home journey. Cheers.